Save that money or invest that money? That is the question of the day and what you should do. Let's talk money.
All we talk is money. All we talk is money. All we talk is money. All we talk is money.
Welcome to Saz Talks Money on Valuetainment Economics. I'm your host, Adam Sosnick, and I'm here to help you build your wealth and save that money. Or, for some of you, invest that money. So that is the question of the day. Save that money or invest that money. What you can see behind me are three major topics. Number one, the money stats in America today. That's number one. Number two, the tail of the tape, saving versus investing. And number three, what you should do. So with that being said, let's jump right in to what's going on in America today. So first and foremost, let me just start with my backstory. So who am I to be talking about saving or investing? Like, what's my story? What gives me the authority to tell you about saving money or investing that money? So let me just paint a picture for you. I knew nothing about money, absolutely nothing about money. I was eager to make money, I knew that, and I got a job as a cold caller for a financial firm back before the Great Recession in 2006. Cut my teeth, I'm cold calling. Next thing you know, I start to make some major money. So fast forward 13 years later, I'm the VP of sales at this major financial firm. Life's good. I've made money, I've saved that money, I've invested that money. But what did I decide to do for you? Like I said, you know what? At the end of the day, I felt very fortunate that I ended up in this field, in this career, that I understand the money game, and I wanted to give back to you. So what did I do? I started this show called Saz Talks Money. And basically, I traveled all over the country asking financial advisors, celebrities, athletes, college students, homeless people even, hey, tell me what you know about money. Tell me what people need to know about money. And the answer was save that money.
Make sure you save that money.
Save that money.
Save that money.
Save that money.
Save that money, baby.
Save that money.
Save the money.
Now listen, one of the things I've learned is they don't teach you this in school. So I've set on a mission to break down money into a language that you can understand. Yes, you. I am here for you. That's what this whole show is about, is to break down money in a language that you can understand. So as I'm doing my thing and I'm running around and I'm talking to people, I say, you know what? This money game that I thought was super complicated and very difficult to understand is actually pretty simple. So what I did is I developed what I call the Saz 6 Principles of Wealth. The Saz 6 Principles of Wealth, the 6 things that you need to know to master your money. Now, if you have not seen that video, we'll definitely attach a link to that at the end of this video. So that'll be up there. So with that being said, the third principle of wealth is to save that money. But the fourth principle of wealth is to invest that money. So there's 6 principles of wealth. Number 3 is to save. Number 4 is to invest. So here we go. I've traveled all over the country. I'm breaking down money in a language you can understand. I developed these 6 principles of wealth. I'm all about save that money. I'm telling you to invest your money. So I've built this entire brand telling people to save that money. But I have a confession to make today. This is the first time anyone's even hearing this. So even though I'm going around telling people to save that money, here's what I had to tell you. The truth is, 90% of my wealth is actually in investments. Ooh, let me say that one more time. I'm telling people everywhere I go, save that money, save that money, save that money. But the truth is, 90% of my wealth is actually in investments. So what we're going to do today is we're going to break down saving and investing and what you should be doing. But first, we're going to get into the numbers, and let's start with income. So let's start with income in America. That's what this whole game is about making money so you can save that money to invest that money. So what are people making in America today? Well, the median household income in America today is just over $63,000. Let me say that again. The median household income in America today is just over $63,000. That's household income. Now, if you want to talk about individual income for a full-time worker, the median income for a full-time worker is $48,000. So what does that mean? What am I saying? That the average household in America today is bringing in somewhere between $4,000 and $5,000 a month. I'm not saying that everybody's making that much, and I'm not saying that people don't make more than that or less than that. Obviously, it varies on your state, your city, your job, your education, but these are the median numbers for income in America. With that being said, let's talk about net worth. If you don't know about net worth, ladies and gentlemen, you're missing the whole point of the game. It's all about your net worth. If you're asking, all right, Saz, what's net worth? Well, I'll tell you, I'll give you a definition. The definition of net worth is your assets minus your liabilities. All right, your assets minus your liabilities. What you own versus what you owe. That's net worth. So right here, we're going to pop it up on screen. You're going to see a graph yourself, but I'm going to tell you right now the net worth in America today, and it's all by age. It's all by age. So if you're 20, don't compare yourself with a 40-year-old. If you're 35, don't compare yourself with a 55-year-old. It's all about your age bracket. So with that being said, let me break down the median net worth in America today. So if you're 35 or under, the median net worth is $11,000. If you're 35 to 44, you're looking at $60,000 median net worth. 45 to 54, $124,000. 55 to 64, $187,000. 65 to 74, $224,000. And 75 and older, you're looking at a median net worth of $265,000. Now you might be saying, those numbers seem kind of low. Well, number one, they are. Turns out people in America aren't saving as much as they should. But number two, what we did is we did the median net worth, not the average. If we did the average, we'd be including all the multi-billionaires, the Bezos of the world, the Zuckerbergs of the world, the Elon Musk of the world, and next thing you know, the numbers will be inflated. So the median number will give us a much clearer picture of what the average person in America truly has in terms of net worth. Now let's get into personal savings in America. So I gotta warn you, these numbers are not pretty. Okay, so buckle your seatbelt and get ready for these numbers. Hopefully, you're going to learn something from this and say, you know what? I don't want to be like most Americans. Most people are most people. Be better than most people. So the personal savings rate in America today is 7.6%. So what does that mean? If you make $100, that means you're putting $7.60 in your pocket. You should strive for at least a 10% personal savings rate. The average household in America today has about $16,000 in savings. Now, if you think those numbers are okay, it's about to get worse. Did you know that 25% of Americans have no savings whatsoever? 25% no savings whatsoever. 40% do not have $400 to cover an emergency, meaning they get a flat tire, they get a car accident, something happens that they got to run, it's an emergency. They don't have $400. They got to put it on a credit card, they got to borrow money, they got to take out a loan. Not a pretty picture. 55% of Americans believe that they will have to work beyond age 65. Now, I plan on working beyond age 65, but not because I have to, because I want to. Something to keep in mind. 69% of Americans don't have $1,000 in savings. That is a crazy number, and here's the craziest number of all that explains pretty much everything. 90% of Americans buy things they can't afford. That's a pretty sad picture. It should go without saying, don't spend money that you don't have. Okay, moving on, the last couple stats. The median balance of a retirement account in America today is $60,000. And here's the number when it comes to investing. Only 55% of Americans are actually investing. So flip a coin on whether you're an investor or not. So that are all the numbers when it comes to income, net worth, and saving in America today. So with that being said, it's now time for the tale of the tape. Saving versus investing. Let's break it all down now. So let's start with the definition of saving. Saving is basically the key to wealth. Saving is putting your cash aside in a safe and liquid account. Two key words there, safe and liquid. Saving equals safe and liquid. You got to get that money, access to your cash, safe and liquid. Now, what's the definition of investing? Well, investing is building your wealth over time, key word there, time, with the help of compound interest. If you don't know about compound interest, it is also known as the eighth wonder of the world. So investing is building your wealth over time with compound interest, where you buy assets where you hope to generate a rate of return. So now that we have the definition, let's get right into it. Risk and reward. So what is the risk when it comes to saving? Well, there's no risk. There's barely any risk at all. Why? Because your principal is safe and you do not have to worry about your principal decreasing. The one catch with saving is this, is a lot of times you don't know this, but you could lose purchasing power to inflation. Inflation on average is between 2 and 3% over a year for the last 100 years. If you don't know about inflation, that's where you lose your purchasing power. As an example, in 1950, a Coke might have costed you a nickel. In 1990, it might have cost you 50 cents, and now in 2020, it costs you $1. But it's the same Coke. That, my friends, is a quick lesson on inflation. So now, what's the risk when it comes to investing? Well, it's obviously a higher risk. Your principal can go up, yeah, but your principal can also go down. Now, this varies by investment. So when you talk about investment risk, you got low risk, you got medium risk, and you got high risk. It all depends on where you're investing. So with risk, you have reward. With risk, you have reward. So what's the risk and reward with saving? Well, it's very low risk, but very low reward. What does that actually mean? It means your returns are basically next to nothing. If you're putting your money in the bank, your typical brick and mortar bank, you're maybe getting 0.05%, maybe, okay? If you're putting it into maybe a online savings account, maybe you're getting 1 to 2%. That's best case scenario. So on average, maybe you're making 1% on your money, maybe. So you're not even keeping up with inflation. So it's very low risk, very low reward. Here's the one thing you got to know when it comes to safety. You are federally insured by the FDIC up to $250,000. If you're like, look, I'm not trying to take any risks. I'm not trying to play around. I just want my money safe. You're insured up to $250,000 by the FDIC. But low risk, low reward. Now, what's the reward with investing? Well, the reward is higher returns. Your money making money on money on money, that's the reward. Okay, when we talk about returns, we're traditionally talking about the stock market or even the bond market. You're looking at returns of 5, 6, 8, 10%, maybe even more if you pick the right stock. So that's where your risk and reward come into. The catch with that is there's no FDIC on your money. If your money goes down, you're not insured on anything. So risk versus reward, saving versus investing. Moving right along, let's talk about the accounts and the products that you have when it comes to saving and investing. So what type of accounts are we talking about when you come to saving? Well, just a bank account. Straight up, we all have bank accounts here. We know what that is. That's where you keep your money. That's where your account is. When it comes to investing, you have a brokerage account. Now, what types of accounts are you going to have in this brokerage account when it comes to investing? Tell me if you've heard these terms before. You got 401ks, you got IRAs, you got Roth IRAs, you got HSAs, which is a health savings account, and then you have a 529 plan. The list goes on and on, but these are the different accounts when it comes to investing. When you talk about products, when you talk about saving, what do you have? We all have checking account, savings account, maybe you have a CD or a money market account, but the bottom line is this is just straight cash. It's a straight cash, homie, like Randy Moss once said. So that is what goes down in a bank account, checking, savings, it's just straight cash. When you're talking about investment accounts, right, what type of products are we talking about? We're talking stocks, we're talking bonds, we're talking mutual funds, index funds, target date funds, we're talking ETFs, and maybe for my people out there that want to get super creative and you want to invest in alternative asset classes, well, you got gold, you got silver, you got commodities like oil and livestock. I know there's a lot of people that do Forex out there, and I know my people love their crypto. So those are the different accounts and products you have with saving and investing. Now let's talk time horizon, aka when you would need this money. Now when it comes to saving, this is short term. I'm talking 3, 6 to 12 months. Maybe on the long end, you're talking 2 to 3 to 5 years at the very long end. This is saving. Now what are we talking about when we're talking about saving? We're talking about an emergency fund, a rainy day fund, or just a good old-fashioned cushion so you're not freaking out if anything happens. That is what's saving. Now what are you saving up for? Maybe you're saving up for a trip. Maybe you're saving up for gifts. Maybe, God forbid, you have a car problem. You got to fix a car. You're saving for that. You're saving to go shopping. What I would recommend as an emergency fund for the common person out there is save up $10,000. Now, you might have just heard what I said. It said $10,000. That seems like a lot of money, especially when you look at the stats over here. But then you might be saying, $10,000, I've got 50 grand in the bank. Well, congratulations to you. But for the average person, try your best to save $10,000. Something will happen to your mentality when you have $10,000 to your name. A lot of weight will come off your chest. It's a very, very beautiful thing to save up that much money. You'll have a beautiful cushion in your life. I encourage you to try it. You'll thank me later. Now, when it comes to investing, what's the time horizon for investing? Well, this is long term. This is long term, baby. Now, let's talk about it. At minimum, minimum, if you're going to be investing, you're going to be in the market for 3 to 5 years minimum. Maybe if you're looking for wealth accumulation, you're talking 5 to 10 years. Now, if you're talking about investing for your kids' college, you might be investing for 15, 20 years potentially. And obviously with retirement, you're talking 20, 30, 40 years down the road. This is long-term investing. So the best way to think about it when you're saving, you're talking days, weeks, months, maybe even years. That's saving. When you're talking investing, you're talking years and decades. So to put it as blunt as possible, this is days, this is decades. You're saving for the days ahead, you're investing for the decades to come. So that's saving versus investing time frame. Now let's talk liquidity. Everybody wants to be liquid, everybody wants liquidity. Well, what's liquidity with cash, with savings? Well, it's high. You can't get any more liquid than straight up cash. You can easily access your cash. That's the whole point of saving. Now, when it comes to investing, it's not as liquid. It depends on what type of account and what type of product you have. So what I have here is 50-50. What does that mean? If you have stocks, if you have bonds, if you have a mutual fund, you could sell that. It might take some time to do the transaction, but you'll have liquidity. But if you're talking about a 401k or an IRA, that is money you will not be touching for 30, 40, 50 years. So there's no liquidity with that. And if you're considering pulling money out of your 401k or of an IRA, just please understand that should be your last resort, and I encourage you not to do that. So that is liquidity. So now obviously we're talking about saving, we're talking about investing, we're talking mostly about bank accounts, brokerage accounts, the stock market. Some of you guys might be saying, well, I'm all about real estate, baby. What do you have to say about real estate, Saz? Well, let me tell you what I will tell you about real estate. I will say that for saving, when it comes to real estate, you got to save up for your down payment. Maybe you need to be saving up 20, 30, 40, 50, 100 grand for your down payment on your house. That's saving. That should be money in savings. Now, if you're talking about investing with real estate, now you're talking about a 15 to 30-year mortgage where you're paying down your mortgage with the hopes of appreciation. So we just learned a lesson there. Saving for a down payment for the 3 to 5 years, maybe it takes you that long for a down payment. Now we talk about investing, time and compound interest, 15 to 30 years in hopes of appreciation. So that's the real estate segment when it comes to saving versus investing. Now let's talk about debt. I know this is never a fun discussion. Nobody likes addressing debt, but it needs to be discussed. So now when it comes down to debt, the relationship with saving is if you have a high amount of debt, and especially if you have a high interest rate on debt, I'm talking 8, 10, 12, 15, 20%, maybe even more, 25, 50% in some cases on crazy payday loans, you need to not even focus whatsoever on investing. You need to save and pay down your debt. Let me be clear on that. If you're investing and you already have debt of very high interest, forget about investing, start saving and paying off the high interest rate debt. Conversely, let's talk about low interest rate debt. If you have college loans or a mortgage and your interest rates are 2, 3, 4, 5%, this may be controversial, but I personally don't think that you should delay investing while you have low interest rate debt like student loans or a mortgage and wait 20 plus years to start investing. So that's the difference between saving with high interest rate debt and investing with low interest rate debt. So that's the debt component. So last but not least, let's talk about skills. Skills pay the bills. What's your skill level? Well, what's your skill level when it comes to saving? Well, it's easy. Anybody can do it. Yes, you can save. Your mom can save, your dad can save, your brother can save, your sister can save, your friend can save, your girlfriend can save, your boyfriend can save. It's easy. Everyone can do it, and everyone should save that money. Now, when we talk about investing, this tends to be a little bit harder. Not everybody can just say, all right, I'm going to invest. However, it is easier these days with online brokerage accounts. However, it's not as easy, but the number one thing is if you're going to invest, you got to start somewhere, you got to sign up. So that's the difference between saving and investing and the skill level. So that's the tail of the tape, saving versus investing. So the big question is what you should do. So what we have here is who should save and who should invest. So let's get right into who should save. You should save if you have short-term goals. I'm talking the next 6, 12 months, 18 months, 24 months, short-term goals. You're going to need access to that cash. We're talking paying rent. We're talking paying bills, credit cards, utilities. You need access to the cash. If you don't have an emergency fund, if you have not saved up at least $10,000, I encourage you to do that. Save that money. If you're all about low risk, low reward, you're not really caring about the interest rate, you just want to stack cash, all good, save that money. And last but not least, if you have an unstable job, if you're not sure where your paycheck's going to be coming from next week, next month, next year, I highly encourage you to stack cash and save that money. So with that being said, let's move right along to who should be investing. You should be investing if you have long-term goals. This is money you're not going to be touching for a long time. Hopefully you understand that. Hopefully you understand the risk and reward factor, the returns on your investment. If you're looking for high returns, then yes, you should be investing. Obviously, it goes without saying, do not start investing unless you have an emergency fund built up. And last but not least, if your job is stable, it's secure, you're not going anywhere, you have job stability, then yes, you can consider investing. So that's who should be saving and who should be investing. So now it's time for my key takeaways. Basically, everything you've learned today, I'm going to break it down for you right now. Number one, you got to understand there's levels to this money game. You got to crawl before you walk. You got to walk before you run before you sprint. There's levels to this game. So understand that number one, you need to have a game plan for your money. You got to understand where your income's coming in, where your expenses are going out. You need to hopefully have a net worth mentality. We discussed what net worth was, not a paycheck mentality. 78% of Americans are living paycheck to paycheck. Hopefully that is not you, and you are understanding the benefits of building your net worth. Moving on, this is what I call the big three with money: debt, saving, and invest. Hopefully you're paying off your debt so you can start to save, so you can start to invest. Let me say that again, the big three of money. You're paying off your high interest debt, you're saving that money so you can invest. Those are the big three right there. Next thing on the list here is having a cushion. There's no better feeling than having a cushion. When something happens in your life, whether it's a car broken down, your girl leaves you, next thing you know, you're getting kicked out of your apartment, who knows what's happening. The fact that you have money saved up, you have a cushion, there's no better feeling than that. Again, I recommend a $10,000 cushion for most people. Cushion is a great feeling. Moving right along, understand that things change and you may need to be flexible. What do I mean? You might have that cushion. You might have paid off your debt. You might be investing now, but things change. You might lose your job. The stock market might crash. You might say, I'm not going to be investing right now. I got to go back to saving. Understand that it's not robotics. You got to be flexible. Certain times you're saving, certain times you're investing, certain times you're cranking up money into the savings account, certain times you're going all in on investing. Things change year to year. You got to be flexible. Moving right along, let's talk about goals. We talk about the average savings rate in America today is 7.6%. Here's my challenge to you. Try your best to save 10% of your income and invest 10% of your income. So what does that mean? I'm trying to encourage you to live on 80% of your income. If you can save 10% of your income and spend another 10% of your income on investing, sky is the limit in terms of your wealth. So that's what I'm talking about with goals. Living on 80% of your income, saving 10%, investing 10%. And last but not least, you can't invest unless you save that money. Hopefully you appreciated this episode about saving versus investing. If you have not seen my episode on how to win the money game, check that out right here. And if you have not seen how to invest today, check that episode right here. And if you have not subscribed to Valuetainment Economics, please subscribe below and smash that like button while you're at it. And as always, save that money.
All we talk is money. All we talk is money. All we talk is money. All we talk is money.